You've brought us some really interesting stuff to chew on today.
Yeah.
This May 2025 article, U.S. Financial Shifts, AI, Debt, and Your Investments. Let's just get straight to it.
Okay.
Our mission here really is to pull out the absolute key insights from this piece and figure out how these big changes could actually impact your wallet and your investments.
Right.
We're not going to get bogged down in jargon. We really want to make this clear and, relevant for you.
Exactly. And this article, it really zeroes in on three major shifts that are worth our attention.
Okay.
First, the increasing role of artificial intelligence at a financial giant like J.P. Morgan Chase.
Right.
Then there's Moody's recent decision to adjust their rating of U.S. government debt.
Ah, okay.
And finally, the Federal Reserve choosing to keep interest rates where they are for now.
Gotcha.
Each of these has its own implications, but maybe more importantly, they're all kind of connected in ways that affect your whole financial picture.
Okay, let's dive right into that first one then, the AI piece with J.P. Morgan. The article mentioned something pretty significant right off the bat. A 10% reduction in staff within their operations-focused roles. That sounds like a big number.
It is, yeah. And the article quotes their CEO, Jamie Dimon.
Okay.
He basically says that while they expect to keep hiring in areas that directly make money, revenue-generating roles,
Right.
AI is going to take over a lot of those, let's call them traditional back-office tasks.
Wow.
What's really striking is how direct they're being about it. It's not some, future maybe thing.
No.
It's happening now at a huge financial institution.
So if you're listening and you work in finance or maybe administration, operations, what should you be thinking? This sounds like it could mean some, real changes in job security.
It definitely highlights a potential shift.
Yeah.
We're seeing AI move beyond just, factories and stuff.
Yeah.
And into more white-collar roles. If we connect this to the broader trend, it really underscores the growing importance of having a different set of skills.
Like what?
Well, the article touches on this. It points to areas like data analysis, actually understanding how AI works, managing tech-focused projects. Having that finance background is still important, obviously, but it might not be quite enough on its own to, guarantee stability in some fields anymore.
But it's not all like doom and gloom, right?
Yeah.
The article also frames AI as a possible area for investment. How can we think about that?
Yeah, that's a really interesting point. As AI gets more common, the companies building and using these technologies could see, significant growth.
Makes sense.
The article mentions a couple of ETFs, exchange-traded funds, as examples. BOTZ, which is focused on robotics and AI.
Okay.
And ARKQ, which invests in disruptive innovation. And that often has a big AI chunk in it. These kinds of funds can give you exposure to a whole basket of companies in this space.
So the big picture with AI seems to be this. It's picking up speed. Really quickly. Could lead to some shakeups in the job market, maybe affect wages in certain areas.
Right.
But at the same time, it's also opening up new career paths for people who adapt and investment opportunities, too.
That's a good way to put it. Now, let's turn to the second big thing. Moody's decision to downgrade the U.S. government's long-term credit rating from AA down to AA1.
Okay, this sounds a bit like financial jargon alert. Can you break that down? What even is a credit rating, and why should a downgrade matter to, someone like me?
Absolutely. So a credit rating is basically an assessment of how likely a borrower is to pay back its debts.
Okay, like a credit score for a country.
Kind of, yeah. And in this case, the borrower is the U.S. government. Moody's lowered their rating mainly because of concerns about the growing national debt and these ongoing budget deficits.
Right.
Especially when you factor in things like proposed tax cuts alongside continued government spending. Now, it's important to understand this isn't necessarily predicting some immediate crisis.
Okay, good.
But it does signal, increasing financial risks for the U.S. over the long haul.
So how does this actually affect my day-to-day finances? How does Uncle Sam's credit rating hit my wallet?
Well, think about it this way. If the U.S. government is seen as even a slightly riskier borrower, investors who buy its treasury bonds might demand a higher return, a higher interest rate, to compensate for that perceived risk.
Okay.
This higher return shows up in what we call bond yields, and higher government bond yields can then ripple through the whole economy.
How so?
It can lead to higher borrowing costs for everyone, affecting things like interest rates on mortgages, credit cards, even student loans.
Ugh. That's not exactly great news for anyone with a mortgage or a student debt.
No, it's not ideal.
What about people who have bonds in their retirement accounts? Is it bad for them too?
That's a bit more nuanced. If you currently hold bonds, a downgrade can sometimes lead to a slight dip in their market value short term. However, the article also points out a potential upside. Newly issued bonds might actually offer higher yields to attract investors.
Ah, interesting.
So that could be beneficial for more conservative investors looking for steady income. But it's definitely something to consider in the context of your whole portfolio.
And I think the article mentioned something about the U.S. dollar, too. How does a debt downgrade play into that?
Yes, good point. If a major credit rating agency like Moody's signals worries about the U.S.'s financial health, it could potentially chip away at international confidence in the U.S. dollar.
And a weaker dollar means?
It makes imported goods more expensive. And, as we all know too well, higher import costs can fuel inflation, impacting the prices you pay for everyday stuff.
Right. Okay, so summing up the debt situation, America's growing debt is a long-term worry.
Yes.
It could mean higher borrowing costs for us individuals and maybe help keep inflation simmering.
That's the potential chain reaction.
It sounds like it might be a good time to take a look at our own debt levels and maybe think about investments that tend to hold up better when prices are rising.
Precisely. Being mindful of your personal debt exposure is definitely a prudent move in this kind of environment.
Okay.
Now, let's shift gears to the third piece. The Federal Reserve's recent decision to keep interest rates unchanged.
Right. The Fed. Always in the headlines. The article says they're in a wait-and-see mode. What are they waiting to see exactly?
Well, their number one focus is still inflation.
Still.
While there's been some progress bringing it down, it hasn't cooled off as quickly or as much as they'd hoped. They're also watching the overall pace of economic growth closely and, like we just discussed, the effects of government spending. By holding rates steady, they're basically hitting pause,
Okay.
taking time to assess if their previous rate hikes have done enough to slow inflation without causing a major economic downturn.
So even though they're not raising rates right now, the fact that rates are still relatively high,
Yeah.
that's still having an effect on us, right?
Oh, absolutely. For people on a fixed income, persistent inflation really eats away at their purchasing power.
Yeah.
Even if their savings accounts are maybe earning a little bit more because of those higher rates.
Right. The savings account yields are better.
They are. The article points that out. You can get better returns on savings, CDs, money market funds. But the flip side is that borrowing is more expensive. And that can act as a drag on the economy, potentially putting downward pressure on stock prices because it costs companies more to borrow and invest.
And the article mentioned how the stock market might react, didn't it? Volatility.
Yes, exactly. The financial markets are super sensitive to signals from the Fed.
Always seems that way.
When rates are held steady but still high, or if there are hints of future increases, it can create uncertainty, jitters among investors.
Which sectors get hit hardest?
Sectors that are really sensitive to interest rates, think real estate, technology, utilities, they might see bigger price swings as investors try to guess how higher borrowing costs will affect their future profits.
So the Fed is walking this tightrope, trying to cool inflation without tanking the economy.
That's the balancing act.
And for us, it means we should probably brace ourselves for interest rates maybe staying higher for longer.
That seems like a reasonable expectation based on this.
And expect some continued ups and downs in the investment markets.
That's a very accurate picture. Now, what's really key, I think, is understanding how these three things we've discussed, AI's rise, the government debt picture, the Fed's policies, they aren't happening in isolation.
Right.
They're all interconnected.
Okay, let's connect those dots then. How do these seemingly separate issues actually influence each other?
Well, think about the Fed's decisions on interest rates. They're definitely influenced by the government's fiscal policy, how much it's spending and borrowing.
Okay, makes sense.
That fiscal policy, in turn, is affected by the cost of paying the interest on the national debt.
Which goes up if the credit rating drops.
Exactly, which can go up if the country's credit rating gets downgraded, like we saw with Moody's.
Okay, I see that link.
And then, at the same time, you've got companies in the private sector, like the JP Morgan example,
Using AI.
increasingly looking to AI as a way to manage their own costs, especially labor costs. And those costs can be pushed up by the very inflation the Fed is trying to fight.
Wow, okay. It really is all tangled together.
It is.
So for the average person just trying to manage their finances, it sounds like we're facing a pretty complex situation.
Yeah, it's a lot to track.
We might see less job security in some fields unless we have those tech skills you mentioned.
Potentially, yeah.
Borrowing is getting more expensive. We might get slightly better returns on savings, but inflation is still a problem.
Still eroding purchasing power.
Right, and the investment markets could be bumpy, but maybe still offer opportunities if we're smart about it.
Exactly. And this leads us perfectly into some very practical advice the article lays out. Concrete steps you can actually take.
Okay, good. Let's get into those actionable tips. First one, diversify investments. In this climate, what does that really look like?
So the article suggests looking beyond just the usual U.S. stocks and bonds.
Okay.
This could mean considering investing in companies based in other countries, international equities. They might offer different growth patterns. It could also mean exploring real estate, a tangible asset, or even looking at commodities like gold. Gold sometimes holds its value better during uncertain economic times.
Got it. Tip number 2, rebalance your portfolio. Why now?
Well, with bond yields potentially being higher, that old 60-40 stock-bond split might need a fresh look.
Okay.
If your portfolio is really heavy on stocks, it might be wise to consider adding some high-quality bonds. They can add stability and potentially generate income from those higher yields we talked about.
So just checking your mix.
Exactly. Rebalancing just makes sure your portfolio still matches your risk tolerance and your goals, given what's happening now.
Tip 3, build an emergency fund. We hear this all the time, but why is it extra critical now?
Yeah, it's always important, but given the potential job market shifts from AI and just the broader economic uncertainties from the debt downgrade and inflation, having that safety net is crucial.
How much?
The standard advice is 3 to 6 months worth of essential living expenses, saved up and easily accessible. It provides vital security if you face an unexpected job loss or some other financial curveball.
Makes sense. Number 4 focuses on us. Focus on skill development. What kinds of skills?
The article really emphasizes skills that AI is less likely to replicate easily.
Okay.
Things like emotional intelligence vital for leadership, teamwork, creativity, innovative thinking, strategic thinking for tackling complex problems.
The human stuff.
Pretty much. And of course, just a general understanding of technology, being tech literate, so you can work effectively with AI tools, not just be replaced by them.
Okay. Number 5, keep a close eye on inflation. How do we do that with investments?
Well, the article suggests looking at investments that have historically done okay or even well during inflationary periods.
Example.
Things like TPS Treasury inflation-protected securities. Their value is designed to adjust with inflation.
Okay.
Also, REITs real estate investment trusts. They can benefit from rising rents and property values, and maybe even the energy sector, since energy prices are often a big driver of inflation.
Got it. And the final practical tip. Review your debt. What's the urgency?
With interest rates likely staying relatively high, it's really crucial to tackle any high-interest debt as quickly as you can, especially variable rate debt like credit card balances or adjustable rate mortgages.
Because those payments can go up.
Exactly. They can become much more expensive in this environment. Paying them down aggressively can save you a lot of money over time.
These are all really concrete, helpful steps. Now, looking ahead, the article also points to some key areas we should all be watching over the next, say, 12 months.
Yes, keeping tabs on these will help you stay informed and, make adjustments if needed. First, future Fed decisions.
Will they hike again? Or maybe cut?
Exactly. Will they raise rates again if inflation proves stubborn, or might they start lowering them if it cools down more convincingly? That's the big question.
What else is on the watch list?
U.S. fiscal policy. Keep an eye on whether any new tax cuts get passed, or if there are big increases in government spending. Those actions can really ripple through the economy and affect inflation.
And circling back to AI and jobs.
Definitely watch the job market trends. Are layoffs spreading beyond finance? And also, what kinds of new jobs are popping up as AI adoption grows? That gives clues about future opportunities.
And finally, just tracking AI adoption itself.
Exactly. Which industries are really embracing AI? How is it changing their business models, their workforce needs? This broader trend has huge long-term implications for, well, everything. The economy, the investment landscape.
So taking it all in, this deep dive into the article really paints a picture, doesn't it? We're navigating a pretty significant period of change.
Absolutely. A transitional period in U.S. economic history.
You've got this powerful mix, AI becoming mainstream, shifts in how the world sees U.S. debt, and the Fed doing its delicate balancing act with inflation.
And in this kind of environment, the article rightly emphasizes that being adaptable, staying informed, and taking a proactive approach to your financial planning.
Yeah.
It's essential.
Yeah.
The old strategies that worked before might not be enough anymore.
So the core message for you, our listener, seems to be, yes, it might feel uncertain.
It can, yeah.
But by being cautious, diversifying, staying curious, willing to learn, you can not only protect your finances, but potentially find ways to thrive.
Well said. It's about navigating, not panicking.
Right.
And maybe. Here's a final thought for you to mull over.
Okay.
Given this increasing integration of AI everywhere, what's one specific skill, maybe even a small one, that you could start learning or sharpening now that would really boost your resilience and your value in this increasingly AI-driven world? Something to think about.